Good afternoon, everyone, and thank you for reading through those disclosures and welcome to Avant-Garde Trading Securities free educational trading webinar. We are happy to welcome our guest presenter today, Keith Harwood. He is joining us to talk about early indicators of a new market trend. Thank you all for joining us this afternoon as well. Keith, are you with us?
There we are. I think so. Can you hear me?
There he is. Yes, I can. Nice and clear. Thank you so much for joining us today and for taking the time to put this presentation together for our listeners.
Yes, thank you for having me.
It's our pleasure. Keith, so you can go ahead and pull up your presentation whenever you are ready and share that screen. While you're doing that, just a reminder for everyone in the Zoom room live here, if you have any questions during Keith's presentation, you can type those questions in the chat box or the Q&A box, and I'll get those over to Keith to address at the end of the webinar, time permitting. Keith, I can see your presentation. It looks great, so feel free to start when you are ready.
Awesome. Thank you again, Natalie, and thank you, AGT, for having me. So today I wanted to talk about the early indicators of a new market trend, as I'm starting to see some signs of a bullish trend in multiple indices, particularly the broad market, but there are some individual indices that might just be getting started. So we're going to get into that today and see how what I look at for to identify that early on. With that in mind, first off, I have to do my own disclosures here. All services and content are provided for educational and information purposes only and are not intended as legal or financial advice. If you do have questions, please consult an investment advisor. Option Hotline is not an investment advisor. It is not registered with the US SEC or FINRA. I'll give you all a moment to read through the rest of these disclosures, and then we'll get into today's presentation. All right. For those of you that are not familiar with me, this is me. I started my career in the option pits of the CBOE back in 2005. So we're approaching 20 years now of trading options. As the market's changed from initially mostly open outcry to electronic to almost entirely electronic now and much tighter markets than they were back 20 years ago, I transitioned to off-floor trading and constructing directional portfolios using options and futures. Initially as a market maker, proprietary trader, and ultimately as a hedge fund trader before joining Option Hotline as the chief option strategist 6 years ago now to share my expertise in options, equities, fixed income, and commodity trading. I think it was just important to me to start to give back and talk to the retail traders about how they can trade with a potential for an increased expected value out of the trading markets. And it's something that I think that hopefully everybody takes some good value out of. And if you have any questions, you can always email me, keith@optionhotline.com, or call me 312-600-8004. Make sure you keep an eye out for support@optionhotline.com for a free giveaway. And yeah, if you have any questions as you're going along, please throw those into the chat box or the Q&A, and I will address them as I can. If I don't get to it during the presentation, I'll be sure to circle back at the end to address any questions that you guys may have. And of course, if any questions come up after the presentation, feel free to email me directly at keith@optionhotline.com. So write down that email address in case you realize something tonight at 2 a.m. and you want to write it down and email me in the morning, feel free. I'll do my best to get back to you as soon as I can. So with that in mind, what are we going to talk about today? Well, what's driving the market entirely? I always look at the fundamentals, even though my norm is to focus on technical signals and volatility-based, options-based signals, because if I completely ignore the fundamentals, then I actually lose sense of where the market could go in an extreme case. So you have to know when there are potential tail risks out there or potential driving factors that are moving the market one direction or the other. Why I use options, of course, with my almost 20 years of trading options, why would I use those instead of just stock? I want to explain that a little bit more to all of you about the leverage, defined risk benefits, and potential risks of using options rather than stock or futures. And then, of course, the main topic of the day, how I find a new trend before it begins. And in particular, we're going to look through some examples of what sectors look interesting today, given those type of setups. So there's a particular technical setup I'm going to really hone in on today. And I have a few sectors that are showing some signs of a new potential trend if that technical setup comes to fruition. So that could be a really exciting way to evaluate some trading opportunities in the near future for you. Main drivers of the market today, of course, are interest rates, inflation, and the FOMC. It's been the case for a while now, frankly. This inflation story has been a repeated concern for many people. Inflation gets too high, things get too expensive. How do we fix it? Do we have to keep raising interest rates? And then inflation starts to come down. Maybe interest rates can come down. The Fed movement from raising rates to lowering rates, et cetera, et cetera. It's a dynamic situation. I think one of the things that we've all seen, though, become very clear is that the Fed's not really interested in seeing the market crash. So if the market starts to drop, tone of speech tends to change in such a way that it helps ensure that we don't get into a true liquidation mode and a true panic. Of course, other fundamental inputs could always appear that create that sort of panic, but I'm personally of the opinion, and this is just my opinion, that the Federal Reserve System is not going to be the driving force of a potential liquidation in the market. I think it's going to have to come from some other fundamental input. That input we may not know yet. So we're always watching for them, always looking for that potential outlier element that could cause a recession or something like that, like we saw back with the subprime crisis, 15 years ago now. But for now, slow and steady wins the race, and it seems like we are continuing to grind higher in the market on the whole, which is why we've got the market conditions that we see now. And again, I'll get into the market conditions a bit more as we go along here. The other thing that seemed like it was going to get started here, but maybe fizzled out, and maybe it's not over, was that return of Roaring Kitty. It's the meme stocks trade, all right? It's what happened with GameStop years ago. It looked like it was going to get started again last week with GameStop, AMC, and ultimately the big winner seemed to be the stock FFIE, which went from mere pennies. I think it was around 9 cents, peaked up around $4 a share. I think part of the reason that that one held on a little more was because if you go through split adjusted and everything else, back when the first GameStop meme stock explosion occurred, it would have been the equivalent of $4,800 or $5,000 a share, somewhere in that range, versus 9 cents and now $1.50 roughly today. So massive potential upside for those that don't look at anything else that's happened along those years. Just start to think about these big dollar signs, and it held on better as a result. At the end of the day, unless we start seeing something more exciting out of the Reddit and meme stock and all that other crew, this may have already fizzled out and may already be over, and we just go back to the mundane, boring Federal Reserve driven stock market. But we can always hope that we get some excitement from this sort of stuff. But this is more of the casino of the stock market rather than the reliable, predictable, or more predictable market driven forces. This is more of that outlier potential. All right, so before I get into the trend signal I'm talking about, I want to start with the options side of it, because the option side is where I get my leverage and my defined risk. But it also has increased risks that may not be present in a stock or a futures trade. First off, transaction costs tend to be higher in options than stock trades because you're trading a leveraged complex derivative. There is assignment risk with short options positions. Today, I'm not actually talking about short options positions, so this is not particularly relevant to the strategy discussed today. But if you are selling options, even as part of a spread trade, you have assignment risk, and that has to be known because that could be converted into a stock position without your desire to do so. And that could increase your capital requirements, create a different risk profile for your portfolio, create a margin problem, et cetera, et cetera. When you are long an option, you have the right, but not the obligation. When you are short an option and you get assigned, you have the obligation to deliver. So keep that in mind when you are selling options. Options do decay in value over time. So when you're buying options, they become cheaper over time from the decay element. However, that can be offset by increasing volatility. The value of options is partially dictated by implied volatility, and this is the expected future movement of the stock. It is constantly changing based upon market inputs, and you will find that as implied volatility rises, the value of options rises along with it. And when implied volatility falls, it makes options cheaper. So options being a leveraged contract and a defined risk contract, the opposite side of that is that you have to pay a premium for them. And if people don't think a stock's going to move all that much, that premium gets less and less. And when they think it's going to move a lot, that premium gets more and more. And we will show some examples of how that works here actually in just a few slides. For those of you that are new to options, I want to remind you of how an option payout looks relative to a stock, okay? So this is sort of a simple introduction to how options work. We're going to get a little bit more complex as I go through a few slides here, and then I'm going to show you directly how that applies to what we're talking about today in terms of this trend signal. So just want to give you a little roadmap there before we get into this. But why I use options is because this is what stock payout looks like when you're buying 100 shares of $100 stock. All right. So when you put $10,000 into the stock market by buying 100 shares for $100, you have this great unlimited upside profile, and max loss is the amount of money invested technically. Now, if I have a stock where I say I have a stop loss, which is a price that I'm going to get out if breached, of $90 per share, then I, in theory, have defined my risk to $1,000, $10 per share times 100 shares. However, there's no guarantee I will be able to execute at my stop loss price. If I woke up tomorrow morning and the stock had terrible earnings and is trading $60 a share, I can't not sell my shares for $90, even though that price has been breached and that was my stop loss. I have to sell at current market prices. So I have more risk than my stop loss, but it is capped by the total amount of money invested into the trade or into the stock. That is important to note with a stock, that a stop loss helps define the risk, but it does not give an absolute defined risk, okay? However, when you go into an option position, a long call, which gives you the right but not the obligation to buy the stock, you can now define that risk on the downside. So if I have the $100 strike price calls expiring in 1 month, let's define what that really means first. $100 strike price means I can buy the stock for $100 per share. Expiring in 1 month means I can buy that stock for $100 per share anytime between now and 1 month from now when this option expires. It's like an insurance contract. At some point, it does expire. Life insurance expires if you have term. There's no whole life options contracts, unfortunately. That would just be the stock trade at that point, I guess. So if that option expires or is valued at $5, remember I mentioned that you have to pay a premium for this leveraged contract. I would be paying a premium of $5 per share. Each option represents 100 shares. So if I want to buy one call for $5, my actual premium paid will be $500 to represent 100 shares. And again, that gives me the right, but not the obligation, to buy the stock for $100 anytime between now and when this option expires in 1 month. If the stock is trading $102 at expiration, I will exercise my call option because I can buy it for $100 a share and immediately sell it back to the market for $102 a share. If the stock is trading $98 per share at expiration, I will not exercise my option because I would rather pay market price of $98 than $100 via the call contract. Now, what this really means is if I wake up tomorrow morning and the stock is trading $60 a share, I don't have to exercise my call. My risk is defined by the premium put into the call option. And if my risk I want to define my risk at $1,000, similar to what I had before, I could buy 2 of these calls for $5 a piece because I'd then represent 200 shares for $1,000. And my unlimited upside is actually more because I've got now 200 shares represented by my calls instead of 100, less the premium paid for the contract. So we can just do a comparison here. At any price between $90 and $110, stock is better. Above $110, my calls are better, and below $90, my calls are better. Because below $90, I've defined my risk and I don't have to worry about exiting at a bad price. And above $110, the leverage of having twice the number of shares represented by my call options kicks in and gives me much more leverage to the upside. On top of that, I do have $9,000 of cash in my account if I buy 2 calls for $5 instead of 100 shares for $100. That doesn't mean I want to go out and spend $10,000 on the call options though, because as a reminder, if this stock doesn't move, I lose everything. So I have to have it go up. And in fact, I have to go have this stock go up at least the $5 of initial premium paid for me just to break even. Really, really what I need is above $110 to feel good about my trade, but $105 is my break even. And anything below that, I'm a bit frustrated that I bought call options because I could have the stock go to $104 a share and I lose $1 a share on my call option instead of making $4 per share on a stock position. This is the difference between when options get expensive and when they get cheap. If those call options were trading for $2 a share instead of $5 a share, my break even comes in earlier and I can buy more of them and get more leverage. So what does this volatility really mean that I'm talking about here? Well, volatility is that valuation part of the options that is the expected future movement. So it's constantly changing as the market conditions change, whether the price goes up or down, or as money flow comes into the market. Because it's expected future movement, it is not entirely dictated by historical movement. So it's always people talk about how, the stock has low volatility recently. It hasn't been moving and it's coming up on earnings. Maybe that means I should buy options. Remember, everybody knows that earnings is coming up. So that's usually priced into the market by the market makers. Otherwise, they'd be giving you this great arbitrage opportunity by pricing options low, even though they know an event is coming up. So finding a technical indicator is usually a better leveraged system for me than having a fundamental indicator that everybody knows is coming. My technical indicator may not be priced in by the market as an expected potential volatility causing event. The earnings announcement or the FOMC announcement or the presidential election or the oil number or whatever is always going to be priced into the market as an expected event. The VIX index, if you're familiar with it, is the implied volatility of the S&P 500 options. So it's an index that tells us what the current market is expecting for the future of the broad market index represented by the S&P 500. It's often referred to as the fear index because the VIX goes up when the markets go down. When markets are panicking, when people are liquidating their positions, they start looking to panic buy put options, which give you a hedge against a long stock portfolio. And you also often see much more volatile movement to the downside than to the upside. Meme stocks seem to be the rare case where upside movement tends to be more volatile than downside movement these days, of course, and years ago. But generally speaking, the old adage is that the market goes up the stairs and down the elevator. Goes up slow, but down fast. And that's why the fear index is often associated with that downward movement. And I mentioned realized or historical volatility. That's what we've already seen occur, but implied volatility is what we expect to see in the future. So realized volatility in the past doesn't guarantee future volatility in the future. Lack of realized volatility in the past doesn't guarantee lack of volatility in the future. However, they are somewhat correlated, and that is also important to note. Okay. I mentioned that options tend to get cheaper and more expensive as that implied volatility input is changed. So I'm giving you a little bit of a price graph here, but think about this as what you might pay at a convenience store for buying your options instead of buying your pack of gum. When implied volatility goes up, the price goes up. When implied volatility goes down, the price goes down. So I've got some comparative values of these call options at various strike prices at various implied volatility levels. All right, so stay with me on this. But if I think that implied volatility should be 36% and it's currently being priced at 30%, it means that I'm getting these calls cheaper than what I think they're worth. So if my fair value, my expected value of the $100 call is that $5 from my first example, but implied volatility has been lowered because of lack of realized volatility or sellers of various options in the market that have driven market makers to lower that input. Maybe I can buy these for $4.20. I'm getting a 17% sale. That's a pretty good sale, right? If somebody told you I can get these options for 17% off, I'd be intrigued. You'll note here that if the implied volatility was high, I'd be paying 16% more than my fair value. So I'm paying a premium on top of having to be correct on my direction. That's why I don't like high implied volatility environments for just buying outright options. I'm paying a premium to get in. But the further out of the money you go, the cheaper or the bigger that discount or premium gets. So with a $106 call, I might say it's worth $270 and it's being priced for $2. I'm getting about a 30% discount. Or in even more extreme case, what if I thought the fair value was 42%? So they were $3.50 was the fair value, and they're being priced for $2. It means that instead of spending $1,000 to buy roughly 3 calls, I can spend $1,000 to buy 5. So that's that great discount. I'm buying something and I'm getting almost twice as many options and twice as much leverage as I would have in the alternative scenario. This is why I look for options when they are on that sale rack, when everything's on sale, okay? And we're going to come back to why that's important right now when we see the VIX chart in just a couple of slides here. But first, let's just show that comparative P&L. So this is really just a matter of that leverage you're getting. When that implied volatility is low, you can see these $106 calls have a much greater payoff when I can buy 5 of them than when I can only buy 3. We'll zoom in so you can see it better. When I can buy 5 of them, if I thought that this stock was going to $120, I've got a potential profit of $6,000 in my bull case. I can still define my risk at $1,000. Of course, my break even, though, requires a move to $108. And I really don't outperform stock until $110 still. All right, so I still need that move to $110 just to do better in options than stock. That's my trade-off. In these more at the money or in the money options, you can see that the options behave more and more like a stock alternative. Stock replacement is what oftentimes we call these in the money options. So these $94 calls, you can see pretty well track the stock price because there's very little excess premium built into these options relative to the amount that is built in because they are already $6, what's called in the money. $6 is $100 the current price minus $94 the strike price. Okay. So my leverage comes from out of the money calls. My stock replacement comes from in the money calls, and I get a little bit of both from those at the money $100 strike calls. I hope that makes sense to everybody. If not, please feel free to throw something in the chat box or that Q&A so I can talk about this further. When implied volatility gets high, on the other hand, you can see that almost everything acts like stock replacement as we get to the upside. But here in that trade-off zone, I'm seeing really big negatives to buying those out of the money $106 calls at a premium, right? My break even's now $110 roughly, $109.51. I think I said those were $3.50 each, $3.51 each. But you can see the upside here, getting all the way to my target price of $120. Now, instead of making $2,000 in stock, I'm making $3,000 in options. That's nice. I can make an extra $1,000. But is it worth it when I know that I have to get all the way to $114 a share before these calls perform better than stock? If I'm worried about the downside, this is not necessarily the trade for me when implied volatility is high. If I think there's extreme upside to $130, $140 a share, maybe a different story. But you can see how when that implied volatility, that expected future volatility is being priced in, maybe there's earnings coming up, maybe there's some other fundamental input coming up. There's really not a great reason for me to push the leverage buying outright call options. I'd be better off doing stock replacement or simply finding a different stock to trade. But here's the good news. This is the VIX right now. So the last 6 months, the VIX really hasn't been any lower than this. All right, the VIX right now is around 12%. That is 6-month lows. That is a very good signal for those of us looking to buy options if we see a reason for movement that's not being priced in. And like I said, I'm not necessarily looking for a fundamental driven movement. I'm looking for technical signal movement, pattern recognition based movement that drives the market to move more than what the market's pricing in. Okay? Right now, the market's basically pricing in a slow grind higher. And even when we see some little panic type events like we saw here in April or back here in October, the implied volatility, the VIX level is only getting into the 20s, which, yes, that's a spike, but it's not near the panic that we saw, for example, during the subprime crisis where we got into the 90s. That was 15 years ago, of course, but these sort of big moves traditionally come with much bigger moves in the VIX than these little moves that we've seen so far. If we start to see some bearish inputs, I expect the VIX to get very high, very fast. But for now, bouncing up into the 20 range and then fading. And when we're at lows like we are right now, we have two potential scenarios, in my opinion, for the market. And it's either to find a trigger that moves us much higher or continue to stagnate and make the VIX prediction actually pretty close to correct, because we're just going to slow grind up or a small pullback and then bounce back and really kind of go nowhere. And a reminder, when we zoomed in on that return, this is the environment we're in right now, that low implied volatility. So if I can find something that's driving the stock a lot higher, this is where I want to look for that leverage and defined risk of options. If I only think we're going to grind higher, then I'm really no benefit between options and stock, but I can use it as stock replacement just to define my risk to the downside in case I'm wrong and the VIX does spike and the market does collapse. I'd like to have that defined risk. So there is some benefits from in the money options, but I see the real benefit from getting that big leverage for an out of the money call option. And that's what I'm looking for right now. So how do I find that explosive setup with the start of a new trade or trend? Well, that's the next key here. And I want to find a technical setup that illustrates the potential from a breakout from consolidation, or that lets me get into a trade at the early part of a move. All right, let me expand on what that really means. Consolidation is that sideways, boring, not going anywhere market. Okay, so when we're consolidating, it really means the stock is in a tight range, not moving a lot. The guys buying call options in that case are not making much money, if they are making money at all, because the market's not moving. So their options aren't coming in the money. It is that trade-off scenario. If we are bouncing between 97 and 103 over and over, you can see that people buying options are doing worse than stock unilaterally. No matter which options they're buying here, they're all worse off in stock, or sorry, in options than they are in stock between that 97 and 103 level. They'd be better suited in stock and just riding it out. But at some point, the market will stop consolidating. We'll have enough of an input to move. And when that new trend starts, the first step really is to stop consolidating and start moving. As weird as simple as that seems, once we stop consolidating and start moving, we really force our way out of that consolidation period. So we have to, it's kind of a question of the chicken or the egg, but the biggest thing is finding a trigger, a price point that gets us out of that consolidation. And usually it comes from one big market participant saying this stock is underpriced relative to the market, or underpriced relative to the fundamentals, or underpriced relative to this, that, or the other, or, contrarily overpriced relative to everything else. Now, fortunately for us, that market consolidation often leads to a lower VIX, as mentioned, and cheaper options. That's what we're seeing right now. That means I can get more leverage if I can get in at the beginning of the move while the VIX is still low and the options are still not priced up and the stock hasn't moved much along that new trend. I'd rather get into a stock trading at the very beginning of a trend, say it's our $100 stock. I'd rather be in at $101 than at $105. Getting into the stock $4 earlier, 4% earlier, gives me a lot more leverage with my options that are already priced low because of the low VIX. Here's an illustration of the consolidation period that I'm talking about. So the main one I talk about here today is going to be called the rectangle, and you can see why it's called a rectangle. It's got a top and a bottom, and it's just kind of a defined time frame here, but it's a rectangle. You can see it. What we see happen is that the stock market or an individual stock is trending higher and then seems to hit what we might call fair value, where people are generally neutral on the price. So maybe it's gone from, say, $90 a share to $100 a share. And at $100 a share, there's some wiggle, maybe bump up to $101, back down to 99, up to 103, down to 97, back up to 103, back down to 97. Somebody's willing to buy for 97 because that's undervalued by 3%, and that's worth putting capital to it. And as you see that there's a big buyer at 97, others start to buy for 97.5, 98, 99, 100. And then they're looking for the seller in the market and they find him at $103. Maybe it's the guy that paid 97, maybe it's somebody else saying now it's 3% overvalued. Until we get to that point where somebody says, you know what, actually, the fair value on this stock is not $100. I think it's 110. And so they're very willing to pay 103. Now, I don't know their value. I know roughly the value from the range here. I could say it's worth around $100 a share if it's trading between 97 and 103. But once we get above 103, I don't know if we're going to go to 104, 105, 110, 120. Who knows? That's the good thing about options is that leverage kicks in when I have uncertainty. I want uncertainty. Now, do I want it to stop at 104? Absolutely not. I'm hoping that we don't have another seller of this market, the seller of this stock, until we hit $110, $115 a share. Or maybe it gets taken over, brand new pricing of $130 a share. That would be spectacular for my call options. And what I do know is that if the market breaks out of that rectangle and then comes right back, it tells me this was just a little bit of a fluke and we've got some defined risk and we're right back into that $100 range. But if we get that breakout and then that continuation, I get excited about the potential that I can get from that leveraged payout of options. The big thing for me is that when I see this scenario, I expect that when we get above $103 a share, we're not going to stay at $103 a share. We're looking to either go up or back down. It's that idea of you don't have to go home, but you can't stay here. So you can't stay here. Usually in these setups, you're either going to go up or down. That's that leverage of options kicking in. Even better is a triangle. It has all the benefits of that rectangle where there's no resistance to the upside, but there's an increased benefit. We've been seeing a strong buyer along the way, driving this higher in that uptrend. So we know that this buyer got more and more and more aggressive until finally he matched up with the seller and exceeded the amount of volume available for sale by the market here, pushing us higher. So we're seeing that aggressiveness within that consolidation. That tight range still leads to lower options prices. And as I mentioned, we're looking at a distribution where I think we're either going to spike higher or go back down to support that lower level. But where we're not going to be is probably where we are there at that inflection point of pricing. The normal market looks like this negatively skewed market where we're going to drift higher or potentially tail risk lower. So with the trend, I tend to look for a negatively skewed market to be the case after the move. But the initial move is this bimodal distribution. Big up or reasonable size down, but probably not small move up or flat. Then we have small move up or flat is the most likely, big move up is unlikely, and big move down is the tail risk. So here's how it looks for the options market then. Let's bring this back up one more time. If I think initially at the beginning of that move, we're either going to go way up or back down to, say, support or maybe lower, then that call option makes a lot of sense, particularly the leveraged one at the beginning part, because I'm looking for a big upside move or potential for a decent sized downside move. This middle ground, that area that I'm giving up potential benefit, where the stock would perform better, is the thing that I think is the least likely scenario. And then once we are trending, I look for stock replacement, more like the $94 calls, because now I think the most likely is the small up move. And I really just want to replace stock, but define my risk to the downside in case of the tail risk. So you can see how these two things really fit together. At the beginning of the part of a move, I want the leverage. And then after the stock has moved somewhat, I want to be in more of a defined risk stock replacement mode in the money calls. The beautiful thing about this is if I'm right and I get in at $101 a share and the stock spikes up, those $106 calls are now stock replacement because they are far in the money when we get to $120 a share, and they act more like a stock position at that point, but leveraged because I have more of them because I got in early. So I'm still representing more than 100 shares, which is the nice thing. I could either take the money on a portion of them or let it all ride. A lot of that comes down to personal preference and risk tolerance and risk management, and is best suited for a conversation with your financial advisor, of course, to determine how you fit into that window. All right. So what we're looking for right now, again, for me, is looking at an out of the money call option that converts to being in the money once I'm right that this rectangle or triangle works out. So let's see what current market conditions are and where I could potentially find this setup. Well, first off, we have the S&P 500. You can see here pretty clearly we've got, let's see if I can draw a line here, an uptrend that's been in existence for quite a while now. And really not much of a long, oops, it was a little low on that one. Let's draw that one more time. So you can see here the upward trend that's been existing in the market for quite a while now. It's just been going higher and higher. We had a little consolidation, and then maybe you could argue for a triangle here coming out of that little dip down. That broke out last week. Looks like the market wants to go higher. Overall, I'd say this was an average at best setup because it wasn't a long enough consolidation to really get me what I want, right? So let's try a different sector to see if there's something more. But I mean, I'm still seeing that uptrend in the S&P 500, so that's a good thing, right? I just want to see if I can find an index that's even better. Well, IWM looks pretty good, the Russell 2000 here. And the reason I say that is because you can see that we've basically just had a range. And it's been from about 195 to about 205. And then we had this triangle start to form. So we didn't have the uptrend leading into it that I do like, but we've had a very long consolidation period in a pretty tight range from 195 to 205, call it. That's about a 5% range, right? $10 on a $200 ETF. That's pretty nice. And that's just breaking out now. That's getting me excited about some smaller cap stocks. We had a couple attempts to break out of the rectangle that failed, but really no attempts to break down from it. So overall, I'm confident that small caps could be a more interesting play, especially with implied volatility where it is. And for those looking for value, I often look at those sectors that have been laggards. Tech and the broad market has been trending higher. And then, of course, tech as the big, one of the bigger indices here and one of the big drivers of the market has had a nice rectangle after the initial, rally trending higher for years. Then we had the pullback that basically set up similar to the small caps, that next triangle. So we had a rectangle, attempted breakdown, and then a triangle back higher, breaking out last week. So all in all, I like tech too. Tech and small caps make a lot of sense to me as ways to, or as places to allocate some potential risk here in the options market because of the setup. Now, it may not work out, and no trade's 100%, but for me, I can get some leverage here with the VIX low. What we're really looking for is something to play out a lot like what I saw from China over the last month. So you can see this rectangle that was occurring in FXI ETF, a tight range. And then when it broke out, all of a sudden it was just a nice trend higher. So it went from rectangle to trend. That's what we're looking for, all right? This is a really nice example of a rectangle turning into a trend with the Chinese market overall, FXI, the large cap China ETF, performing really well. So let's see, given that, if I can find another rectangle in a smaller sector. I'm going to look at 3 in total here with you. Semiconductors, number 1. Again, we see that uptrend. And then we see the rectangle. This looks a lot like tech. No surprise because semiconductors have been a leading indicator of tech. But overall, a bit of a rectangle there with the pullback and then the triangle. It's great, a great setup for a sector that had been trending higher. We'll do it again. Look at biotechs. This looks a lot more like the small cap drawing with a little bit of the tech influence here. You've got the rectangle after a bullish trend, and then you had this start of a triangle. So once we get above about $140 a share in IBB, I'm excited about biotech. This is one that's still to come. That's why I liked pulling this one up as opposed to tech or the S&P 500 or small caps or FXI, for example, that have already happened. Biotech is one that I can watch now for that potential entry point. It's exciting to me when I see these things getting started. And then, of course, last but not least, retail. And in the last week, we've had a little bit more of a pullback here, but we had a trend and then we had a little bit of a dip. But overall, I saw a nice little rectangle here after that trend. And you can see that we tried to just kind of push through. I'll extend this out. After trying to fail, it didn't really fail. We came right back, and now we're bouncing in here. But if we get back close to those highs here, not necessarily the high of last, I believe that was Monday, but the highs, of say March, late March, that could be an indicator of a bullish breakout for retail stocks. So the retail index ETF, XRT, is another very interesting sector for me to look for out of the money calls once my price trigger hits. So that's the key to me, is looking early on in retail and biotech, given what I'm seeing in big tech, small caps, China, and as I mentioned, semiconductors. All of these things are just getting started, but there are more names that could be to come in that setup that I was highlighting today. This is where I get excited about the market again, is looking forward. If you have questions, feel free to throw those in the chat or Q&A box now. Or, as I mentioned, email me, keith@optionhotline.com. Call me, 312-600-8004. And always be sure to keep an eye out for support@optionhotline.com for a free giveaway that'll be hitting your inbox, I believe, tomorrow. And with that, if there are any questions, I'll take them now.
Yeah, thanks so much, Keith. I'm just going to ask you to leave this slide up just for a minute so people can write down your email and phone number if they do indeed need to reach out for you for anything. Thank you so much for that wonderful presentation. That's a lot of good information. I know it usually takes people some time to ingest, and like you mentioned earlier, if anyone finds themselves with a question at a later date, you can either shoot the question directly to Keith or over to us at Avant-Garde if it's about webinar specifically. We do have a question right now coming in. The question is, Keith, I was late to the presentation. Is there a recording? I can take that question. The answer is yes, we are recording this afternoon's webinar. We will be sending out the link to the recorded replay sometime tomorrow, and that is going to come from the email info@tradeagt.com. So keep an eye out on your inboxes for that email, and you should get that sometime tomorrow, as I mentioned. Keith, I'm going to go ahead and take control of the screen back just for a moment here. We are pushing up right against our time frame here, so any last minute questions we can squeeze in. Otherwise, as we noted, please feel free to shoot your questions over to Keith directly or over to us at Avant-Garde Trading if you have webinar specific questions. All right. Thank you again, everybody, for taking time out of your days to join us live. And Keith, thanks as always for presenting great information, and we look forward to having you back at a future date.
Thanks again, Natalie.
Sounds great. Yes, one more question coming in. Yes, the recording link will be available tomorrow, and that will be emailed out to everyone from info@tradeagt.com. Thanks again for everyone for joining. And don't forget to visit our website, tradeagt.com, go to the education page, opt in to get those webinar invitation emails so you don't miss any free educational webinars moving forward. Thanks, everybody.